Welcome to this high-level explainer. Today, we're diving into the Strategic Wealth Briefing, the 10 pillars of capital. Look, if you're a busy professional, you already know money touches basically every single part of our daily lives. But honestly, how often do we actually step back and analyze the underlying strategy driving it? Well, that's exactly what we're going to do right now.
So why do some people effortlessly build wealth while others just constantly struggle financially? It's kind of the ultimate question, isn't it? As high achievers, we naturally have this innate drive for success. But here's the reality. Without the right strategic framework and a real understanding of how money actually operates, even the highest earners can fall way behind. The stakes for mastering this intel literally couldn't be higher. All right, here's our executive summary for today's briefing. We absolutely respect your time, so we're keeping this highly structured. We're going to cover the operating environment, tactical execution, environmental forces, leverage and growth, and then finally, the ultimate objective. Let's just jump right in and define the playing field. Phase 1, the operating environment. Okay, before we can tactically build capital, we really need to understand the ecosystem it lives in. What actually is money? I mean, it's not magic, right? It's simply a mutually agreed upon value system that was invented to solve a massive problem: barter. Think about it. Thousands of years ago, trying to find a perfect trade, like a farmer trying to trade wheat for a fisherman's catch, was just incredibly inefficient. Money completely solved that bottleneck. Fast forward to today, and money operates on three absolutely non-negotiable pillars. It's a medium of exchange, it's a store of value, and it's a unit of measurement. Without those three core functions, our modern, fast-paced economy simply wouldn't exist. Next up, we have banks. Sure, they're vital safe houses for keeping our capital secure, but strategically, they are the absolute leverage engines of the economy. They pool our deposits together and then lend them right back out to fuel growth. We're talking mortgages for real estate or large loans for massive business expansion. That continuous lending cycle is literally what expands our entire economy.
Phase 2, tactical execution. All right, this is where we pivot from those macro concepts right into your personal action plan. Think of earning as your financial offense. Most people generate income by trading their time and skills, whether that's through a corporate job, running a business, freelancing, you name it. The absolute crucial takeaway here is that your income is a direct reflection of the market value of your time and skills. That's exactly why highly successful people are just relentlessly investing in themselves. Earning more is the essential first step because higher value directly scales your earning potential. But hey, if earning is your offense, keeping it is your absolutely critical defense. Top financial experts swear by a tactic called paying yourself first. Here's how it works. Say you bring in $1,000. The strategy dictates systematically pulling out 10%, so $100, and dropping it straight into savings before you pay a single expense. Over time, you're systematically building a liquidity buffer, and that protects your capital from those unexpected life shocks, like a sudden job loss or a medical emergency. Phase 3, environmental forces. So now we have to face the invisible market forces that are constantly working in the background. And believe me, they are either working for you or against you. Let's look at interest. It's basically just the cost of borrowing or the reward for saving. If you borrow $100 at 10%, you owe 110. That right there, that's executing a losing strategy. But if you save that same $100 at 10%, suddenly you have $110. You are executing a winning strategy. It's the exact same mechanism, but it completely dictates whether you're growing your wealth or just digging yourself a deeper hole. And then, of course, there's inflation, the slow, gradual erosion of your purchasing power. It's the force that takes a $5 burger today and turns it into a $6 burger next year. Your cash is literally buying fewer goods. This is exactly why just hoarding cash under the mattress is financially dangerous. Inflation acts like this hidden tax, which means your money has to be actively growing just to break even. Phase 4, leverage and growth. To really scale wealth, we have to move into some more advanced tools, starting with credit. Look, sometimes you just need capital before you've actually earned it, borrowing today to repay later. When used wisely, this is strategic good debt that actually helps you build assets. But if used carelessly, it quickly morphs into toxic bad debt that just finances unnecessary spending and liabilities. To outpace that inflation we talked about and truly scale, you've got to deploy investment vehicles. We're talking stocks, real estate, bonds, and businesses. You're injecting your capital into these assets, fully anticipating growth. Now, unlike a standard savings account, they do carry risk. But historically speaking, accepting that calculated risk is the required premium for building true long-term wealth. Phase 5. The ultimate objective. All right, let's tie this entire briefing together with the ultimate growth engine, compound interest. Albert Einstein reportedly called it the eighth wonder of the world, and honestly, he hit the nail on the head. Why? Because it is the explosive exponential power of allowing your money to literally earn its own money. Here's the actual mechanic of compound growth in action. Let's say you invest an initial $1,000. In year 1, you earn a solid 10% return, giving you $1,100. Pretty good, right? But the real magic happens in year 2. Now you're earning interest not just on your original $1,000, but on that new $100 as well. You let that play out over a few decades, and it creates this massive exponential curve, turning small, consistent investments into an absolute mountain of capital. So what does all that compounding actually achieve? Financial freedom. The end goal of capital isn't just mindlessly hoarding cash, it's buying back your time. It is that exact beautiful point where the passive income generated from your assets fully covers your living expenses. Work officially becomes a choice rather than a necessity. Now, achieving this takes earning, saving, investing, and a whole lot of patience. It doesn't happen overnight, but every single strategic decision you make moves you one step closer. I want to wrap up this explainer by challenging you to evaluate your own financial posture right now. Ask yourself this really provocative question. Is your capital just buying you things, or is it buying your freedom? Remember, money isn't magic. It's just a tool, and the better you understand how to wield that tool, the better your financial future is going to be. So start learning, start saving, start investing, and let time do the heavy lifting for you. Thanks so much for joining me for this strategic briefing.